Hi everyone. Today we'll be talking about the Buffett indicator. Now, what is the Buffett indicator? Elite finance investor Warren Buffett uses an indicator which he calls as the market to GDP ratio. In the market to GDP ratio, he compares the GDP of the country to the prevailing market prices, and from there he evaluates whether the general economy is in a boom or in a recession or is it slowing down. Because in the assumption behind it is that in the long run, the market reflects the GDP, which is a fair assumption to make that in the long run, if the country is growing at a certain pace, then the market will also be growing at the same pace. Now, the market is the summation of the growth of all the companies in the economy, private limited, public limited, government companies, banks, everything. Now, there's no proper indicator apart from the GDP itself to compare the market prices. So the closest we can get to the market price is a index of a listed company. Now that is not a very good assumption because even the best of the indices, like the Nifty itself, are about 60% of the listed prices on the NSE. Now there are private limited companies as well, which are big, but Nifty is the closest we can get to a general market sentiment, and that is the purpose of the indicator as well, to reflect the general market sentiments. So our second assumption is that a market index reflects the market prices fairly. Now, sometimes we have seen a divergence between the small cap, the mid caps, the Nifty. We're going to assume that they all work in tandem, and in the long run meaning a period of minimum 5 years, that in the long run, the market prices are incorporated in the market index. So what we are going to do here is we are going to take the ratio of the market prices to the GDP. Now for that, we first need to have the data of the market prices and the GDP. So we'll first hit the GDP. I've already made some Google searches. I searched for India's quarterly GDP growth data. The first link here is statistictimes.com. We go to that link, statistictimes.com, and it gives me this page, and it gives me a set of data for in a constant currency term and at current prices. Now, the constant currency growth is the real GDP data, whereas current prices growth is the nominal data. We can use either one of them because later in this tutorial, we're going to take certain ratios from where the inflation data is supposedly cancelled out. Because, and here's the third assumption, which will come later, that the inflation is constant in the short run. So when we're going to take the ratio of the short run data, we're going to assume that the inflation is constant. Now the market prices itself, the Nifty itself is a nominal data. So it would make sense to compare it to a nominal data set. That is the current prices GDP growth, which is not the numbers you're used to seeing. You're used to seeing these numbers. We are often saying that India's GDP growth rate had been 7 to 8%, which had slowed down to 4 to 5%, which is what is reported in the news, which is what we're used to seeing. However, these data sets are the nominal data sets, which are inclusive of inflation. Again, inflation is going to be cancelled out. We can use either one of them. Let's use both of them. So we copied this data and I'm going to paste this data over here. Okay. So I have data starting from FY 2012-13 quarter 1. That is June 2012. That is my first data. So here I'm going to refer to the quarter. Since GDP numbers are related to a quarter, I need to have a particular quarter in mind. So this will be 30th June 2012. And I can drag this all the way down to current times. That is, we're going to have a quarterly data. So this is the end of the month and one quarter is 3 months. So we have a date format. I'm going to freeze the panes here. And we drag it down. 31st December. And we are currently in April 2020. So we should get data till 31st March 20. Right. Now we want GDP nominal and GDP real. Now here it gives me the nominal GDP rate and the total GDP. So let's see whether this makes sense or not, whether the sum of these four values actually comes to this value. So let's say my GDP at the beginning of the year was 100. GDP is, we can use indexation for this. So I'm referring to the year 2018-19. This year, in the first quarter, my GDP growth rate was 7.95% per annum in a quarter. So what I'm going to do is, I'm going to increase this by one quarter. However, this is an annual figure, so I'll have to divide it by 4. And I forgot to put on the percentage sign because the percentages are not written here. So this will have to be divided by 100. And we have made a mistake over here. What is the mistake that we have made? The divided by 4 does not go here. It goes here. Since this is the value for an annual growth and the rate of interest itself has to be divided by 4. Right. This is a 4%. So this is a 7.95% growth rate. Empirically, this makes sense because 7.95 is almost equal to 2%. It's almost equal to 8%. 8% in a year means 2% per quarter. So 1.99% makes sense. And we can drag this formula. So at the end of the fourth quarter, I get 107.02%. Whereas if I take an annual number, so I should get 106.81. This is the difference. Why are we getting this difference? Because the quarterly GDP growth rates are the year-on-year growth rate in the GDP for that quarter. It does not mean 7% increase from quarter one, which we have taken over here. We have taken a 7% increase from a previous quarter. That is not how it works. It works in terms of it is a 7% increase from quarter two of the previous year. This is the year-on-year growth rate, which is how GDP growth rates are calculated. So if I have the GDP of 100 over here, the GDP for the next year would be 7% increment. And each quarter would be a summation of the GDP growth rate of the previous quarter for the previous year's same quarter. Now that will just complicate our calculations. What I'm going to do is, I'm going to assume that these numbers, since they are not too different, I'm going to assume that these are quarter-on-quarter growths, and every year I will make one adjustment to make the annual numbers consistent. So even though we will have certain complications in the short run, in the long run, since the annual growth rates are definitely year-on-year growth rates, the curve will smooth out to give me the annual GDP growth. Now, first I have to incorporate this data into this data over here. That is going to be a challenge, yes. It starts from here. I can either drag and drop it like this, or I can do something better. See, these are numbers in a quarter, and this is a table in a quarter, right? So I'll just add a row here, add a column here. I'll index this thing. So this will be 1, 2, 3, 4, and this will be 13, 14, and so on. And I'm going to use the index function to take the GDP data over here. How are we going to do that? Is we're going to take the index function. We're going to take the array that we want. That is going to be this array. And freeze it. Now my row number is going to be the row number is going to be difficult, but fear not. I'm going to use the index function. This is the array I want the data from. What is my row number? The row number is 4, and the column number, the row number is 1, 2, 3, 4, 5, 6, 7, 8. And the column number is 1. Similarly, next it will be 8, 2, 8, 3, 8, 4. Then 7, 1, 7, 2, 7, 3, 7, 4. Then 6, 1, 6, 2, 6, 3, 6, 4, and so on. So that is the formula I have. Right. I'll add 2 columns over here temporarily. That is 8, 1, 8, 2, 8, 3, 8, 4. And if this number is 4, then I want this minus 1. If this number is equal to 4, then I want this minus 1. Else I want the same number, so I get 7. And if this number is equal to 4, then I want 1. Else I want this number plus 1. Right. So I can drag this down. Perfect. And instead of writing 8 and 1 over here, I can link it to this. And this. So let's see if we're right in this. So for 31st December 2015, that is Q3 for FY15, the GDP growth rate comes to be 7.2%. Q3 FY15. Q3 FY15, the GDP growth rate is not 7.2%, it is 5.92%. This is FY16, yes, FY16. FY16 7.2%, FY16 is 7.2%, yes. For FY15 Q3, FY15 Q3 is this 5.92%, 5.92%. Perfect. So we're done here. And since I want these all in percentages, that will be helpful for me. I'm going to divide this by 100. right? And this was the constant currency prices. So this is actually the real GDP growth. So we have the real GDP growth. In the same way, we can do the nominal GDP growth. Only my array will be shifted. The rest, everything will remain the same. Right. So I'm simply going to copy this, paste it here, the formula, and I'm going to just change the array. And something went wrong because I did not freeze the array. And we're done. We have data only till September 19. So we do not have this data. That is okay. Okay. Now I also want the annual data. So GDP nominal annual and GDP real annual. Now this number will only come for March because that is where we get the annual data. Right. So this is already codified. For the real growth rate, I'm going to use the first array, and the answer for quarter 3 is this one. So this is where I want to pull my data from. And this is 13, 14, 15, 16, 17. So this is done. I can freeze this. The work of this is over. Now I want the year in which such data is coming. So that is easy. If the month of this thing is equal to 3, then I want the year of this thing, else I do not want anything. I don't want the year, I want the year minus 2000. In Excel also you have to do some hit and trial before you finally arrive at the answer. That's okay. So if this is equal to nothing, then I want nothing. Else I want a number coming from, we're taking the nominal growth rates. Nominal growth rates is this thing. So I want the data from there. The row number should be matched by my lookup value will be this. My lookup array will be this. And I want an exact match. And again, so the annual growth rate for FY15 should be 10.99%. And it is FY15, 10.99%. Perfect. So this is done. And again, I want a percentage value. So this is equal to this. Then I want nothing. Else I want an index of this. And before the last bracket closes, I want a divided by 100. Yes. So here we have our nominal data value. Similarly, all I'll do is change the array. So in the GDP sheet, I have taken L4 to L11. Instead of L4 to L11, I will this time take G4 to G11, match it with the GDP A4 to A11, that will remain the same, and we're done. Right. Now I have to make an adjustment because what is happening here is the annual GDP growth should have been equal to 5.46%. Now, if I start with the GDP of 100 and I raise the GDP quarterly, so 100 multiplied by 1 plus 5% divided by 4, it gives me 102. It does not give me 5.46%, it gives me 5.62%. It's a minor deviation, but a deviation nonetheless, which I'll like to correct. So I have to do an exponential adjustment. How do I do that? The 5.46%, I'll adjust one of these quarterly data sets to reflect this data. How do I do that? So I'll take the most divergent from the 5.46%, that is coming to be 7.49%. We'll adjust this. How will I adjust this? So these four should come to be 5.46%, right? I can use an Excel gold seek function, but I would much rather use the mathematical function so that I can copy paste it later. What would be the mathematical function? So the mathematical function says that these four should be equal to this, right? It is much easier to show you this on paper. Let me give it a try. Yeah. So what I'm saying is I have an initial GDP G naught, and it goes through 4 quarters. 1 plus Q1 by 4 plus into 1 plus Q2 by 4 into 1 plus Q3 by 4 into 1 plus Q4 by 4, and that should be the same as my G naught multiplied by my annual GDP. So that is 1 plus A, right? And I have to adjust one of those quarterly numbers. So it doesn't really matter mathematically which quarter I'm changing because they're all symmetric. I'm going to solve this equation. So this G naught and G naught gets cancelled. Let's say we're going to change quarter 1. So 1 plus quarter 1 by 4. My handwriting is a little poor here. 1 plus A whole divided by 1 plus Q2 by 4, 1 plus Q3 by 4, 1 plus Q4 by 4. So this is what we get. And so Q1 is equal to this entire behemoth, let's call it B. So B minus 1 multiplied by 4. So let's just write it in Excel. Oh, my frame got moved. Just a moment. So let's write it in Excel and reduce the size of this. I have my annual GDP numbers. So first I'll take up this. So the most divergent from 14% is 16%. I'm going to adjust this one. I'm going to say that you are equal to 1 plus A divided by bracket open 1 plus Q1 by 4 1 plus Q1 by 4 multiplied by 1 plus Q2 by 4 multiplied by 1 plus Q4 by 4. This entire thing goes into a bracket. So where this is our B, and this entire thing would go into a bracket minus 1, and this entire thing goes into a bracket multiplied by 4. So it should give me something near to 7%, but not exactly 7%. No, it was earlier 16%. Now we have adjusted it to 13%. Now, does this give me the correct answer? 113.82%. 113.82%. Perfect. So this is the adjustment that we have to make for each and every quarter, every year. So let's do that. The most divergent between 13. Let's do it one method at a time so that it doesn't get confusing. Or rather, we have the data for both the sets, but let's just work with the nominal values. Let's not go into the real values as of now. We have that data set for our reference. So FY13 has been adjusted. Now these all values are annual, but they're still linked to the GDP sheet, and there's no use of that. I'm going to value paste this. So I do not have any use of this column anymore. FY14, 13%. I have is most divergent with both 15% and 11%. I can diverge either, but just let me see that which one would make most sense. So it's 12.97%. This is a 1% deviation. This is a less than a 2% deviation. This is also less than 2% deviation. I think I'll adjust this. Just need to work with the values and we're done. We do not have to choose the most divergent quarter. We can technically choose any quarter because the annual values are going to remain the same. It just is neater when you take the most divergent value. In fact, instead of the most divergent, I can take the value which is the highest in the 4. So in these 4, I can change this. Be sure that the rest of the 3 values are of the same year. That is an adjustment that I'll have to make every year. So amongst the 4 of these, the highest value is 11.5%. I'm going to adjust that. Have to be June, September, December, March. Amongst these 4, the highest value is this. I'm going to change that. Or I could have chosen to change the last quarter. It really does not matter. I can change the same quarter every year. That would not have made this task so difficult. That's okay. June, September, December, March. Yes. So now my quarterly values will give the same result. This I cannot adjust, so I'll take it at face value. Now just for a sanity check, I want to see whether my quarterly values and my annual values are giving the same results. So this is a quarterly value, hence I'll divide it by 4. This is a nominal, this is an annual value, hence I will not divide it by 4. This might not be a real thing, so I'll take the value of this. And it still does not make sense. So this is actually a blank cell. This will not help me in my sanity check. Right? I can drag this one down. This is just a check that we are doing, nothing else. If at any point our value is wrong, means we did some mistake in the calculation. Nothing, this is perfect. So we are done with the GDP. Now we have the quarterly GDP data. Perfect. Now we want the market values. So the market value prices had to affect the GDP. We are just done with one part of this tutorial. And now we'll move to the market prices. As we had assumed, the Nifty is a good indicator of the market price. Yahoo Finance is generally very good in giving us the historical data. So I have taken the Yahoo Finance data and I have searched for a period of April 2020, 2019 to 2020. Now I want data from June 2012. Just in case the markets were closed on 30th June, it's safer to take data from 1st June itself, 2012, that's right. And up until, I want the data till 30th September 2019. I download the data. And here it is. Now the data is a daily data, whereas I want the quarterly data, but doing a simple index match will not work because the quarterly data might, because the market might not be open at the end of a quarter, like 31st December 17 might be a public holiday, or it might be a Saturday or Sunday. So, but I can still work with this. First, I'll just take this sheet. I'll move it to my Buffett indicator sheet. So I'll have just one sheet to deal with. And I'll call this market prices. Sorry. So I'm going to take the closing value and I'm going to take the market price. This is again a nominal value. So I'm going to search in this particular array, frozen it. I'm going to match. My lookup value is going to be this number. My lookup array is going to be this thing. And I would, so in case the market is closed at a certain day, I am good with a day previous to that, or 2 days previous to that, or the last day when the market was open. So I'm good with a less than figure. Does this help us? 2579 on 30th June 2012. Is this right? 30th June 2012, 2579. Yes, because 30th June the market was not operating. So I have the data for 29th June. That is 2578.9, 2578.90. Perfect. Let's drag it down. Let's do one more check. 30th June 2014, 7611.35. 30th June 2014. Again, the market was closed on 30th June. It would have been a Saturday and Sunday. So the closing price was 5842.2 and I am getting 7611.35 because I am checking the wrong year, 30th June 2014. $7611.35. That's the closing price. Is it the closing price? Should have frozen this. So yeah, we'll do one more check. 30th September 19, 11512.4. 30th September again the market was closed. The last price 11512.4, 11512.4. Perfect. So we have the market prices. It's a fairly nominal value. However, our GDP is still in terms of growth rate. It is not in terms of a nominal value. So I need to create an indexed GDP. Now the indexed GDP for the first year, it would be 100. It really doesn't matter what value you take for the first year, as long as it is some value, because we are only interested in the growth. Quarterly growth divided by 4. And we have the indexed GDP. Yes. That's my phone. So what is the Nifty to GDP ratio? I can take the market price to GDP ratio. And this is what is called the Buffett indicator, market price to GDP. And we have our Buffett indicator over here. We see that it really doesn't move much. It went up and it went down. It's fairly stable in the long run. And which is supposed to be the case, since the market price in the long run moves hand in hand with the GDP, it should be a very fairly stable quantity. Now let's take a 3-year average of the market price to GDP. So 3 years, would be 12 quarters. So I cannot take the data of the first 12 quarters. And this will be the average. And this is the average we have, yes. And so I can take from a 3-year average, because the 3-year average is an indication of what has been the market price to GDP, the average market price to GDP of the country over the last 3 years. It should be even a more stable quantity. And compared to that, what is the GDP to market price right now? So it gives us the level of overvaluation. Now, overvaluation can be computed as the difference between these two divided by my reference point. So I can say that the market is 11% overvalued, but to be honest, I really do not prefer this formula. I prefer an exponential overvaluation function. That is the natural logarithm of this. So that gives me 11% as well. And we have the overvaluation, right? So what does this look like on a graph? So let's put in a graph as well. Select data. So first thing I want to put in is the Buffett indicator. These values are going to be market price to GDP for this entire duration. And this is the timeline in which the Buffett indicator moves. So the Buffett indicator has been very stable throughout this time. Now, what's the 3-year average Buffett indicator? It will be even a more stable quantity. So over time, the 3-year Buffett indicator has actually not moved much, but it also gives us an idea of when the market has been overvalued and when the market has been undervalued. This also gives us a fair value because in May 2014, when the Indian elections happened, the market was fairly overvalued. Then again in May 2019, somewhere over here, the market seems to be fairly valued. Now, how has the Nifty behaved during this time? So I'll take another data set. I'll take the Nifty, wrong place, Nifty. And Nifty behaves in a different chart altogether. So let me use a combo chart. Where do I have the option of a combo chart? Secondary axis, yes. And just for ease of reference, for this particular Nifty, I'll use a different chart type. Yeah. So you can see, even though the Nifty has consistently increased, but a lot of it has been due to inflation. Most of our growth has been in terms of the GDP growth rate. The GDP, the average Buffett indicator has been very stable, and the current Buffett indicator has moved in tandem with it, sometimes going above it, sometimes going below it. The overvaluation or the undervaluation has also not been much. It was 11% in March 2015. It went down to minus 12% in December 16. So this was this time. But apart from this, the market has generally moved in tandem with the GDP growth. So if I have an idea of where my GDP is growing, which a lot of agencies are able to correctly project, then I can have a fair idea whether my market is overvalued or undervalued and by how much. Meanwhile, the market keeps on dipping and increasing depending on the inflation. So that was the Buffett indicator, how to calculate it and what it is. Again, I'll refer to our three assumptions that in the short run, the market reflects the GDP. In the long run, the market reflects the GDP, not in the short run. That creates market fluctuations. And we have seen that is actually the case. That is very fairly the case. The market index reflects market prices fairly, which is again what if you're a trader, if that's what you're trading for, that is a fair assumption to make. And inflation is constant in the short run. So this entire model is based on the consistency of inflation in the short run. Since we are taking growth ratios, the inflation should be cancelled out. However, if it deviates significantly in the short run, the inflation will not be cancelled out. So that is it. I'll take your questions in the comments now. Thank you.